Hello, everyone. This is Tim Leveroni. I want to thank everyone listening to this market update call. Our goal is to educate you on the market environment and share perspectives from some of our investment managers we recommend. Shortly, I will introduce our speaker, Ryan Dietrichs. He will present LPL Financial's outlook on the current markets, interest rates, tariffs, and address concerns of a recession. This call is being recorded today. There will be no questions during the call. If you have any questions, please call or email us. Mr. Dietrich earned his Charter Market Technician designation, has a BS in Finance from Xavier University, and an MBA from Miami University. He holds a FINRA Series 7 and 66 through LPL. As Vice President, Senior Market Strategist, Ryan Dietrichs is a member of LPL Financial's Research Tactical Asset Allocation Committee, responsible for directly impacting the portfolio decision-making process, as well as a member of the Market Insight Team, developing and articulating equity and general market strategy. In this role, he is frequently a presenter to client industry peers in the national media on emerging markets and developing market trends. All right, Ryan, take it away.
All right. Thank you, Tim. Appreciate that intro. So first off, I'd like to say thank you for having me back. I'm honored and delighted to be here today to talk a lot about what's going on since our last quarterly update, right? It's going to be fun, and a little bit about me before we get into it. I know Tim just obviously gave a good intro there. I've been with LPL 3 years this month, so senior market strategist. Like we said, I get to do a lot of fun things like presentations like this. I travel a good amount to present at trade shows and for our advisors and different events that LPL has. I get to go on TV down here in Fort Mill, South Carolina, where our LPL campus is. We have a nice studio, so I joke, I throw on a tie, I go downstairs, and I try not to make it too memorable. If you're on TV, if you made it too memorable, it probably means you're messed up. But it's a lot of fun to get to do things like that. So as a market strategist, I say, we're kind of like a draw the snowman, meaning we do the big picture things, the big macro views. Is there going to be a recession? Do we like stocks over bond? Do we like a large cap over small cap? Then I work very closely with our 55-person research team, portfolio managers, other market strategists, and we create a lot of the overall content and overall market views at LPL Research that we then share with our advisors. And we also manage money, right? We manage a lot of our advisors' money, and we invest kind of the areas that we like, and that's really what we're going to focus on a lot today. We're obviously going to focus a lot on also what just happened in the fourth quarter, and so far the nice bounce that we've seen so far this year. So let's get into it. So there you can see on the slide, LPL Research Economic and Market Outlook. That's me, Senior Market Strategist. So the very first thing we'll talk a little bit about is kind of what just happened. Obviously, we're going to do forward looking also, but we have to definitely spend some time and focus on what happened in the fourth quarter. Get down to it. Obviously, it was a very horrific quarter for stocks. As you can see here, on the left, that's kind of the equity world. Equities around the globe were lower. The S&P 500 closed down 14% in the fourth quarter. That was the worst quarter since the third quarter of 2011. That was a U.S. debt downgrade. It was the worst fourth quarter since the financial crisis. Historically, fourth quarters are normally kind of strong, and clearly that wasn't the case in the fourth quarter. Now, how rare was what happened in December? December, the S&P dropped over 9%. December was the worst month of the year for stocks. Going back to 1956, when the S&P 500 moved to 500 stocks, so a long time, December had never been the worst month of the year. Well, it was last year. So that just tells you how rare it was. Now, as you can see on the left, emerging markets actually held up pretty well. Large cap value also did well. There's the S&P down about 14%. On the downside, obviously the small caps really got hit hard. Small caps did pretty good last year in the first half of the year and really dropped in the second half of the year. Then mid caps obviously kind of trailed also. Now, when you talk about what happened in the fourth quarter, it's tough to just say, well, it was because of this, right? In December, at least, why did the market drop 9% when the month is usually strong? We think there's a kind of a combination of things. First things first, we're going to talk about the Fed. the Fed had a pretty big disconnect with what the market thought. Now, what I mean by that is back in October, the Fed Chairman Powell made the comment, long way from neutral. What's that mean? Well, he was saying, hey, we might hike rates more than the market thinks. I was on October 3rd. If you look when all the volatility really started, that's about when it all started. So the market wasn't buying what the Fed was selling. The Fed was saying we're going to have maybe 4 rate hikes this year, 2019. And the market didn't believe it. Market participants can actually kind of, make bets, I guess you'll call it, on how many rate hikes there'll be. And that was much higher than the market participants thought. But when you get a disconnect between what the market thinks and the Fed, that can lead to some trouble. The last time we saw a big disconnect like that was late 2015, early 2016. You remember back to that time, that was a pretty vicious pullback. A lot of financial stocks were cut in half, energy stocks cut in half, S&P pulled back 14%. And eventually the Fed markets kind of had a kumbaya moment, and the markets and Fed kind of agreed with each other, and the Fed didn't really hike rates too much in 2016. So you fast forward to today, in October, the Fed was saying, long way from neutral. December 19th is the last time we had a Fed meeting other than the Fed meeting this Wednesday this week. And the Fed made the comment autopilot, saying that they're an autopilot regarding the overall balance sheet of the Fed. But the market heard the word autopilot, kind of freaked out. That was the worst 1-hour sell-off we had all year back on December 19th during the Fed meeting. There was a Q&A session afterwards. So again, market freaked out thinking, oh my goodness, so the Fed's not data dependent, they're not going to be patient, they're just on autopilot. And that's, again, that really big sell-off into Christmas Eve, the Christmas Eve lows. Well, January 4th of this year, Fed Powell came out and said that we're patient. So we're more patient now. And obviously, since January 4th, we've had a really good rally. At the time of this recording, S&P is up almost 6% for the year. Small caps are up double digits already with, just about a day or so to go before the end of the month. So we have definitely bounced back, and it's the market's way of kind of now the market, it doesn't think there's maybe going to be one rate hike, and the Fed's kind of come around to that. So the Fed disconnect was a big part of the fourth quarter sell-off. Also, oil was down 22% in November, crashing, if you will. That led to some disconnect and some volatility. Then, of course, the trade stuff. We'll get into that. But the trade concerns with China continue to swirl. So all three of those things, the Fed, trade, and oil, really were kind of catalysts, if you will, for the big sell-off we saw in the fourth quarter. Also, we didn't know it at the time. We know it now. There were the most monthly liquidations from hedge funds we've seen so far this cycle in December. So once the market started selling off, a lot of those hedge funds started kicking in, algorithms started kicking in, and you just had a sea of selling. So all of those factors really played into the fourth quarter. Really good news is we're going to get into. We had about a 19.8% correction in the fourth quarter on the S&P from the December 20th high until Christmas Eve lows. So we'll call it about 20%, pretty close, right, for government work. And if you look historically, in non-recessionary environments, that's kind of where markets tend to bottom, right about 20%. Recessionary environments, yes, you can get larger sell-offs, but it's very important to note, and we talked about this at the time, down 20%, if you're not in a recession, which as I'm going to lay out here next half hour or so, we don't see a recession happening in 2019, maybe not even in 2020, not till 2021. This cycle definitely has legs of growth, in our opinion. And that might be kind of where markets bottom. And sure enough, that's kind of been the case. So that's a lot about the fourth quarter and kind of a little bit about the forward-looking first quarter this year and then also 2019. But let's talk for just a second on the sectors on the right of the screen there. Utilities, obviously a very defensive play, the only thing up. On the downside, you can see energy, technology really were hit hard. Industrials this year are actually one of our favorite groups, financials and industrials for that matter, I should say. You talk about industrials, we had some solid earnings from some big companies all of a sudden this earnings season. Also, industrials really were held back, we think, due to the China trade concerns. You're not going to invest in yourself. You're not going to invest in new, CapEx, capital investment. You're uncertain about trade policy, and that's why we saw trade policy come to a screeching halt. A lot of investment come to a screeching halt in the fourth quarter. Really good news, though. Industrials are doing very, very well, and so are financials. We think there's a very good likelihood that there can be some type of resolution with China here over the coming months, and that should be a big-time tailwind for some potential outperformance in industrials. Turning to the other side of things, fixed income in the fourth quarter. Obviously, it was a decent quarter for bonds, right? I mean, overall, as I'll get into, when it comes to fixed income, last year we had more of a neutral stance. We did expect stocks to outperform bonds. That did not happen with the S&P down 6%. But at the same time, coming into this year, we think bonds will be relatively flat, and that's kind of what bonds were last year, really. But you can see what did well on the right there. U.S. Treasuries, it's longer term, higher quality bonds did very, very well. Mortgage-backed securities, that's MBS there, that's the third one. Those are a little higher quality, and it's actually a group we do like in 2019, as I'll discuss. So those hung in there. Then on the downside, it was, kind of some of the lower quality things that really didn't do well. High yield corporates, bank loans, and then preferreds also obviously the lag, but the bank loans and high yields were two of the lower quality things that are out there, and both of those obviously didn't do well. High yield tends to act a little bit more like stocks anyway. So if stocks are up, high yield tends to do a little bit better. When stocks are down, not really a surprise to see high yield corporates down. But overall, the bold Barclays U.S. Ag, that's kind of your average bond fund, if you will, gained a couple percent, again, on the heels of the S&P down 14%. Once again, hammering home why a well-diversified portfolio, even though we like stocks over bonds this year, we still think there's always a place for bonds in a diversified portfolio, especially when you get, hopefully not too many more quarters like the fourth quarter. But when you have a rough quarter, that's exactly what could play out. So it's a good look, I think, at last quarter. Now we'll kind of look forward and talk a little bit about, kind of what we see in 2019 and in the first quarter. So here's our nice, outlook, fundamental. I'll stick here for a second. So, we talk about fundamental. Now, what do we mean by that? Well, call us old-fashioned at LPL Research. We still think fundamentals drive long-term stock gains, whether it be direction of interest rates or overall earnings profitability. And the S&P was up 9 years in a row, a record heading into last year. That's on a total return basis, tied the 9-year win streak in the 1990s. The important thing to note is when you think about that, maybe markets were due for some type of a break last year. Now, again, if we come into last year, a year ago right now, and you would have said, hey, Ryan, S&P earnings are 25% this year. GDP growth will be over 3% for the first time since 2005. I probably would have told you, hey, stocks would be a good place to be. That type of profitability, that type of growth, and inflation still would have been relatively low. That would have probably been a good time to be in stocks. At the same time, it didn't really play out like that. And why exactly did we have such a good year for the economy, to be honest, but not for stocks? Well, up 9 years in a row, maybe it's time for a little bit of a break. But the uncertainty factor, again, in January, we would have known these things. What happened? Well, then the uncertainty and the curveball, if you will, I guess, of the China trade things really seem to put a damper on the overall market, along with the new Fed Chairman Powell, which we'll talk about more. Markets have a funny way of testing new Fed chairman, and that's exactly what we did see. But overall, we look at the fundamental backdrop. We just do not see a potential recession this year. And here's something to think about. I think it's really important for investors to know. You look since World War II on the S&P 500. It has been down back-to-back only twice, 1973, 74, and then a 3-year period right after the tech bubble, 2000, 2001, 2002. That is the only times we've had back-to-back down years since World War II for stocks. Now, it's also really important to note those were recessions, right? 73, 74, then the tech bubble recession. Well, in other words, one could say, we've never had 2 down years in a row without a recession. The S&P was just down 6% last year. We don't see a recession this year. If we get any good news, there's a lot of negativity out there. Let me see, I've got it written down here. The consumer confidence, here we go. Consumer confidence just came out, and one of the things that the conference board does is they ask average consumers where they think stocks will be in 1 year. Well, the bottom line is, do they think stocks will be higher in 1 year? Bottom line is, and this data just came out earlier this week with the consumer confidence, only 31% of those polled expect stocks to be higher 1 year from now. What's that mean? That's the lowest number since November 16, obviously right before the election when there were a lot of uncertainty and concern. So a year ago right now, the S&P is up 15 months in a row. Earnings look good. You've got the tax reform coming in that should boost corporate profits. Things look great. Well, maybe almost too good, one could argue. Now you fast forward, things aren't terrible by any means, but they're not great. But if think about those expectations, lowered expectations when you have good news, it's easier to jump over that bar. And right now, we think that's kind of the case that we have, with a lot of people not expecting much out of the economy or stocks this year. And then you look up, and S&P's up almost 6% for the year in January already. Yes, it's an oversold bounce, no question. But again, if we get any resolution with the Fed, which it looks like we are, the Fed going on kind of a pause on interest rates, which we'll talk about here in a second, there are definitely some positives to think that stocks will not be down 2 years in a row. We do think stocks will likely outperform bonds. So what we're going to talk about today, I've obviously touched on some of these already in my opening comments, but policy, economy, fixed income, and then equities. So policy, what's going on? Well, a lot out of Washington, right? Every single day seems like we have something out of Washington. And I love this chart here that we have on policy, because we break it down by Democrat president, Republican president. Clearly, we know we have a Republican president, but we just also had midterms, early November of last year. And now we have a split Congress. As you can see on this chart, when you have a Republican president with split Congress, actually that's the best scenario, up almost 16% on average for stocks on an annualized basis for the S&P 500. Then you see Democratic president up almost 16%. Not quite the best scenario, but the bottom line here, history tells you gridlock is good. I think we've all probably heard that. And that is kind of the way our forefathers wanted it, right? Have the checks and balances. You can't get too extreme one way or the other. And as you can see, a positive makeup potentially as Republican president with the split Congress. So, something else to think about, midterms just took over here, or just happened here. We went back to World War II. Stocks have never been lower 1 year after the midterm elections. That's a lot, right? That's every 4 years going back since World War II. Why is that? Why do stocks tend to do well the year after a midterm election? You look back at history, going back to 1900. The president who just won tends to lose about 30 seats in the House and loses a couple seats in the Senate. Well, President Trump lost, I think, around 40 seats approximately in the House, did gain a little bit on the Senate. Nonetheless, what we see happen in history with presidents is they kind of get their comeuppance, if you will, with the midterm elections. Maybe lose a little bit more than they thought they did, and they realize they got to come to the table and bargain, right? And they want to get reelected. It isn't about Democrat, it's not about Republican. It's all about getting reelected. And usually, whatever the fiscal policy or the monetary policy that's put in play, tax reform or whatever it might be, usually things are put in play that third year to kind of get the economy going, get the stock market going, get people feeling good, and get reelected. And it's happened throughout history, with regardless of the president. When you talk about, again, every single year after a midterm year, the S&P 500 is higher. So that's just something to think about in the back of your head as we progress through 2019. Fiscal policy. So, clearly one of our big views, this is the second longest economic cycle of growth since, since World War II. This June, I believe it is, or June or July, sometime this summer, it'll become a 10-year economic cycle. Longest economic cycle of growth since World War II, at least using data back to World War II. What does that mean? Well, it's an old bull market. It's an old economic cycle. But just because it's old doesn't mean it has to stop. And in fact, as I'm going to lay out here, we see reasons to think this economic cycle could have at least a couple of years left of economic growth. And with that, should lead to potentially higher equity prices, more volatility. Late in the cycle, you get more volatility. Let's get that out front. But still, there can be some opportunities with that volatility. So the fiscal stimulus, specifically the tax reform that we had late 2 years ago, I guess at this point, deregulation on financials and energy are potential positives on the fiscal front, and tax reforms, the other big one. Repatriation, which is simply taking money from overseas, bringing it to the U.S. and investing in it. Look at Apple out in California, brought a lot of money back and built a really nice big super complex. And other companies have done similar things with that. Our thinking there is using fiscal policy. It's all about CapEx. CapEx is investing in yourself, capital expenditures. If companies do that, which they were at about a 10% clip the first half of last year, that can lead to higher productivity, that can lead to higher wage growth, and then that can extend the overall cycle. And when you talk about it, for 8 years or so, we had monetary policy leading the stock market higher. That is simply the Fed, right, keeping rates low, expanding the balance sheet, using policy from the fiscal side of things, from the monetary side of things, to get the economy going and confidence up. Well, you could argue, again, without a 3% annualized GDP print since 2005, longest streak in our history, and the real median income about flat since 2000, that means including inflation, one could argue that, you know, the economy really hasn't done as well, I guess, as we would have liked. There's the stats that say this is the weakest economic recovery this country's ever seen. And stock market's done great, though. So what we're encouraged by is the fact that now, yes, we are using a little more fiscal policy to extend this cycle, opening up a toolbox, so to speak, for some growth. And what we have here on the screen about fiscal stimulus, as I was talking, 2.1% GDP, fiscal stimulus is a percent of GDP. When I heard that the first time, about 2 months ago, really surprising, to me at least. You know, a lot of the knock on the policy that we have had put in is it's a one-time sugar high. The market knew this is a one-time sugar high. Things are going to deteriorate next year. That's why you had good earnings growth, good GDP, and the stock market didn't do anything last year for the most part. It was flat to down, you know, flat to down, pretty much down. At the same time, when you look at this, there's still a lot of potential fiscal stimulus in the system in 2019, even more than we had last year, which I think is surprising to probably a lot of investors and people. And it's just another potential tailwind to say, hey, you know, government spending makes up 10% of overall GDP. Consumer spending is about 2/3 of it. Well, you know, using fiscal policy as a stimulus, it's still definitely a pretty nice backstop and tailwind, I guess we'll call it, for potential fiscal growth in 2019. Fed policy is a neat little story. So the blue is the 10-year yield. So yields have been going lower for a long time. As you can see here, you know, we kind of joke that one of the reasons we do expect higher yields coming you know, this year, and you tend to see higher yields when you have a stronger economy, which we do see happening, and some good news. But clearly, the fundamental thing we say is that those are the Fed chairmen, 6'7", Paul Volcker, and then Alan Greenspan, Bernanke, Yellen, and now we have we do have a taller Fed chairman. So the kind of little joke we make is maybe now we'll have higher moving rates. Now we have a taller Fed chairperson. But the bottom line here, the neat thing about it is when Greenspan took over in '87, took over in August of '87, right ahead of the '87 crash, of course. Now Greenspan was in charge of the Fed the longest. I mean, the 15 Fed chair people going back to 1913. And he also saw the largest stock market gains. But remember, August '87. Market has and then the crash of '87, obviously soon after. Markets have a funny way of testing new Fed chair people. Sure enough, this is what we saw with Greenspan. But when, right about a year ago, I think it was February 3rd or 4th, was Fed Chairman Powell's very first day. The Dow dropped 4.6% on his very first day. Go back and look at it, right about a year ago, early February. Talk about a bad first day at the office, right? And then you think about what just happened. The S&P, 10% drops first half of last year and a 20% drop the second half of the year. Well, the market sure tested the new Fed chairperson. Now, there's other factors out there. We get it. But still, that's the way markets tend to be. So looking again at last year, midterm years also tend to be the most volatile out of the 4-year cycle. So we really saw some of those things play out. But then again, I mean, I kind of already touched on a lot of the policy things with Fed Chairman Powell, where the market was kind of not seeing what he was seeing. And then now it does appear, using the word patient and look at the economic data a little bit more, that the markets and the Fed are much more in alignment than they were just a couple months ago. So that's a potential positive. And overall, you know, we think the Fed is probably going to go on pause a little bit here. You know, they did 4 interest rate hikes last year. They've done 9 so far this total cycle. And they could be nearing potentially the end of interest rate hikes for a while. At the very least, maybe take the first half of this year off, maybe one more hike late next year. But we've done work on that. And the bottom line is when the Fed takes pauses for a while, markets tend to do pretty well 3 and 6 months out. And just in theory, if December was the last hike, which we don't think it necessarily was, but it could be. We just wrote about that in one of our weekly market commentaries. What's the market do after the last hike of a cycle? With the last 5 cycles, 3 and 6 months later, you actually get outperformance. Even out to a year later, you get outperformance on the S&P 500 after the last interest rate hike. A lot of people think the last interest rate hike means you're just going to go straight to a recession and the market's going to go straight down. That's not what we found. So those are important things to note. Should the Fed take a little pause here, look around. Yes, the global economy is weakening, but at the same time, U.S. data pretty strong. We're looking at, I'll talk about earnings. We're looking at a really solid earnings season overall. Once again, and earnings drive long-term stock gains, and we're looking at that again here. So this is kind of, I'm going to keep it simple, but it's really powerful. The Fed's funds rate right around 250 right now. It's Fed controls short-term rates. They do not control long-term rates. But if you consider inflation is running right around 2% or so. two and a quarter, depending on who you look at. And I think what we have here, yeah, we use CPI in this. There's different inflation gauges. But the bottom line, so that's almost a zero. On a real basis, the real effective Fed funds rate is about 0%. When you consider rates are 2.5%, inflation is about 2.2, 2.3%, just slightly high, slightly above zero. That's what this chart shows. The very powerful thing to note, those little shaded areas, those are recessions, okay? And as you can see clearly, I think, the last, 1, 2, 3, 4, 5 recessions all saw the real effective Fed's fund rate up around 4% or so approximately on average, ahead of a recession. So this is just another way for us to gauge kind of how close are we to a recession, when's the true trouble going to come? Well, we don't think so. And this says the Fed could have a little bit more room to kind of potentially hike rates, but just a really good sign to us, at least, that you're not necessarily nearing those troublesome end of the road, end of the economic cycle periods when we look at the real effective Fed's fund rate. Turning to the economy. So, overall, we're going to likely see 3% GDP growth last year, first time since 2005. We're going to see a little slowdown, though. Our estimate's a little bit under 3% or so, maybe 2.5, 2.75. I guess on here, yeah, that's what we have, 2.5% to 2.75-ish. So a little under that. Emerging markets are a group we really like. So just under 5% emerging market growth this year and last year. So we still think there's a lot of growth at emerging markets, some really good valuations coming out of emerging markets. If you don't think there's going to be a global recession next year, which we don't, emerging markets, which kind of got beat up last year, could be a really nice place for investors to find a little bit of alpha, that's outperformance in some of their investments. We still like the U.S., though. We still think the U.S. is a really good place to be. And the thing important to note is, yes, earnings growth is going to slow this year. Earnings growth 25% last year, give or take. We'll see what the final numbers are, but it's pretty close. This year it's going to be more like 6, 7, 8%. Probably a little above the long-term average, but still, so people are going to say, hey, earnings are slowing. GDP growth was 3% last year. It's going to be 2.5% this year, or GDP growth is slowing. And those are all true. A lot of the economic data, manufacturing very likely is peaked as well. So what does that mean? If we're slowing, does it mean the market's just going to come crashing down? No, we don't think so, and it doesn't. As I'll kind of lay out here. Bottom line is that things are slowing, they're still growing. 2.5% GDP with above average earnings growth, with low-ish inflation, with an accommodative Fed, with maybe some potential positive on the U.S.-China trade concerns. Hey, those are all things to us that we think stocks can gain potentially double digits on a total return basis. Turning back to what we have on the chart. So Europe developed ex-US, think Europe when we say that. I've been there 3 years, and one of the number one questions we get is, when is LPL going to turn bullish on Europe? When are you guys going to invest in Europe? Well, we haven't yet, and we haven't done it yet, and I don't think we're about to start. We still see a lot of trouble with Europe potentially from just kind of how the slowing growth, Brexit, all types of things are still there. Let me just do one thing. Here we go. All right. My wife keeps calling. I'll just text her. I'll do 2 things at once. I don't know what she needs, but she know I'm doing a webinar right now. Anyway, so with that out of the way, so we talk about Brexit and some of those concerns. Europe's just an area that we're still underinvested in the models and how we look at the world. Even though Europe's underperformed the United States for a very long time, we still think it's time to go into that area yet. Developed markets, though, on Japan, we do think Japan potentially can outperform the United States. Outperform Europe. And we're a little more constructive on Japan than we are international developed, but there's still trouble there. Then at the bottom, unemployment, inflation. Those could tick up a little bit potentially, but still not any major problems really with the employment picture or inflation. So crude oil, I talked a little bit about this. Crude oil had I think it was down 22% in November. That led to a lot of the volatility in the other markets that we saw with the December sell-off. So overall, crude oil does seem like it's found a bottom. OPEC has come out and said that they're going to try and do what they can do with the cuts to keep crude oil above 50, really. I mean, 50 is a level that we've seen and heard and read about. It's a big level for capital investment, that CapEx, that big theme that we think is needed to extend this business cycle when it comes to energy companies. And OPEC knows that, and oil's back above 50. At the time of this recording, oil's having a pretty good bounce as well. So we think kind of the lows in oil have been put in. We're not big oil bulls here, or bears for that matter. We think oil can kind of just stay between 50 and 65 for the most part of the year. But the big sell-off that happened in the fourth quarter is fortunately behind us, and we think that's a pretty major thing that's out of the way just to kind of cause market troubles. Fixed income market. Let's talk about fixed income now. U.S. yield curve. You know, keeping things simple, this is a 210 spread. So it looks at the yields on various maturities of bonds, the 2-year and 10-year bonds specifically here. Keeping it real simple. When this goes beneath zero, which you can see it's down, I think it's about 15 basis points now, but it looks like about 20 basis points here. It's been flattening, meaning it's been going lower. 9 of the last 9 recessions, going back to the 50s, saw an inverted yield curve. That means that line there goes beneath zero, okay? And the media love to point that out. 9 of the last 9 recessions see 9 of the last 9 recessions see an inverted yield curve ahead of time. People are worried about that. Well, let's talk about it for a second. The yield curve is not inverted, first off. And the similarity we see right now with yield curve, which way are rates going? Rates are going higher, right? Yields are actually going higher, and we think that can continue. So you've got the yield curve flattening, meaning it's going lower, but rates and yields are actually going up. The last time, I don't want to get too technical on it, that's called a bear flattening yield curve. The last time we saw something like that was the mid-90s, when rates are going up, yields are going up, but the yield curve is flattening. Well, the mid-94, 95, really. That wasn't the worst time for the economy for a couple more years of pretty solid economic growth. It wasn't the worst time for stock market for a really good gain. We're not predicting something like the mid to late 90s, but we do see the similarities that, hey, you know, what's going on here? Well, the Fed, we know, kept rates lower. They outright said it. They kept rates lower than rates would have been in a free market to keep the economy stimulated. They had a very large, $4.5 trillion balance sheet to try to stimulate the economy, which they're kind of running off now. Running off means letting it sink a little bit and letting some of those bonds mature. Bottom line, though, there are some things that are put in place that we think are kind of making the yield curve potentially go lower. Our overall stance, though, this year is we think the yield curve start to steepen a little bit, and that would mean it starts to go higher. And that could be a positive thing specifically for financial stocks. Banks do better when the yield curve is steepening. And you look at banks' financials, they kind of had a rough year last year. Well, they're up huge so far this January. Now, they are also one of the most beat up groups, so it's an oversold bounce. But our opinion there is we really like the value group over growth, and financials are a big part of value. So should the yield curve start to steepen, that would be a big encouragement, we think, for the overall economy and for financials. But let's just say in theory the yield curve does invert later this year. Believe me, if it does, you'll hear about it because the media will be talking about it. Does that mean you just panic and sell everything, go to gold, go to cash, hide under your bed for a while? No. You know, we've taken a look at this. It takes about 2 years after the yield curve inverts before you get to a recession. Stock market goes up about 19 months on average and gains over 22% on average after the yield curve inverts. So it does mean you're late in the cycle. It does mean, hey, there's time to get your portfolio set, but you probably should go a little more bonds. You should go a little more defensive. Don't be so aggressive with industrial, technology, financials. Those are groups that we do like here still based on the economic outlook we see. But it doesn't mean you just hide all of a sudden when you have an inverted yield curve, and that's a very important point. Also, the important point is we're not inverted yet, so it's concerning, but a generally flattening yield curve isn't necessarily bearish. History tells us, and you can stay flat potentially. I should have mentioned this. So last time we saw a similar looking yield curve with the overall yields going higher was mid-90s. Well, the yield curve stayed flat for a couple of years in the mid-90s before it ultimately inverted in the late 90s. Fixed income corporate spreads. You think the bond guys are the smartest guys in the room, which we kind of do. Corporate spreads and high yield spreads in the credit market will tend to say, hey, something's wrong here. Now, as you can see, the yellow line there, we saw a pretty big spike in corporate spreads there on high yield bonds as well, and that was a sign the markets are panicking. You know, ahead of the big correction in 15, 16, credit spreads blew out and showed worry in the credit markets. Ahead of the financial crisis, we saw some significant worry. Well, the good news here is, on a relative basis, yes, it spiked higher, but I know this chart only goes back to, what is it? I guess January. It's about a year. If you went back, decades, the recent spreads that we've seen in the credit markets here is actually in line with kind of historical averages. So it's just come off such a historically low level that spreads aren't as high as it might feel because we haven't been this low for a long time. But hey, spreads did go up. The real good news is this December, they really imploded on the downside too. So long story short, bond market was quite concerned about a potential recession late last year with all the volatility and worry. It's really come back in. Credit markets are calming significantly, whether you look at investment-grade corporates or high-yield bonds, and those are some positive things for the fixed income world. So So lastly, on fixed income, kind of what do we see? Well, we think that 10-year yield potentially can go up between 325 and 375. Again, kind of step higher. Not for a massively spiking higher 10-year yield, but we do think it can continue to go up. A higher trending 10-year yield normally is going to pressure bonds. It's just kind of that simple. Rates go up, yields go up, bond prices tend to be pressured a little bit lower. If that were to play out, that's kind of where our overall stance of relatively flat bonds this year and a little bit outperformance in U.S. equities, or equities in general. Bonds might not be, the safest place to be. At the same time, there's always a place for bonds in a portfolio, and this is what we're kind of showing when we say, a period of higher rates. What tends to do well? Well, mortgage-backed securities, as you can see there, it's MBS, and high yield tend to do well. It's also treasuries, which are those long-term investments, safe investments from the government, tend to do worse. How are we positioning our fixed income models here at LPL? We're shortening up duration. Again, keeping it simple. What's duration? You can buy bonds out, any period you want out in the future. Well, the shorter duration, meaning the shorter the period before they expire, they're not as affected by interest rates going higher. So we're shortening duration, not buying 20-year bonds. We're just shortening up there. But also, there's high credit, fixed income, and low credit, right? I mean, high yield. Another word for high yield is junk. That's the same thing, really. So we're kind of lightening up on some of the lower credit things, and we're increasing our overall credit. Overall, we want better credit exposure when it comes to our fixed income. So shortened duration, higher credit things are the type of things that we're investing in. Definitely mortgage-backed securities, I'd say, is probably one of our favorite areas because that is higher credit than just overall. We like investment-grade corporate bonds as well. Bank loans are kind of more of a neutral type of feel. We liked them a lot last year as rates went higher, but they are a little bit lower on the credit side. And then just long-term, high-quality bonds are still something we wouldn't outright avoid. But again, if rates go higher, that's not probably the best place to be on the fixed income side. Still has a place for it in a well-diversified portfolio, but maybe just a little underweight. So with that, let's get to the fun, at least I think the fun stuff, equities. So we got the longest bull market in history going on here, but take a note. That's assuming December 20th was the high. We think this bull market still has time. We think new highs are quite likely sometime the second half of this year on the S&P 500. At the same time, it's going to take a little time to work to get there after a 20% correction. But as you can see, 1990 bull markets in blue gained up over 400%. This one peaked, I think, around 325-ish, so about 100% more on the magnitude of that one. We've got duration in terms of the length of this bull market, but in terms of the overall magnitude, a little bit lower. But still, the longest bull market ever. We absolutely think, as I laid out, no recession coming. We think this bull market still has legs and still has maybe a year or two left at least. So, we just had the 19% correction, as you can see here, into Christmas Eve. Kind of what happened, we had that triple bottom, as you can see, right around Halloween, right around Thanksgiving, early December, and then boom, broke the triple bottom. A lot of hedge fund liquidations, a lot of algorithm trading, and that was a massive panic selling into Christmas Eve. S&P corrected about 20%, as you can see, as we all remember. I mean, I remember going Christmas Eve thinking up in Ohio, seeing my family, and expected to kind of take a day off, I guess, right? Kind of take a break. Unfortunately, that wasn't the case. We worked all day, which is fine. That's how it goes sometimes. Obviously, a lot of concern, and we did everything we could. I remember actually going on TV that day after, so the 26th, to come on and talk about all the, I was on vacation again, but it's how it goes, and it's okay. But talking about all the big sell-off and what it all meant, and I kind of laid it out there on December 26th on Fox Business, saying, hey, this is a rough sell-off, but the fundamentals are still what matter, and they still drive long-term gains. And this might be a really good chance to actually add some risk to equities, even though it felt really scary. And sure enough, now as we continue to rally since then, I guess it's easy to look back and say we were right. But the bottom line here is, will we go back and retest, right? People want to know, well, will we go back and retest those lows? You think back to big sell-offs, 2011, 2016, last year. Markets had a big low, bounce for a month or two, then go back down and test those lows. So we think it's possible that we could go down and test those lows, although we don't think it's quite as likely. I don't want to get too geeky here, but last week we saw 71% of stocks in the S&P 500 make a 20-day high, and that's extremely rare. It's a lot of participation, a lot of strength in the overall move. Really strong 3- and 6-month returns after that type of rare event takes place. So to us, yeah, some pullback and some consolidation, but maybe 2,500 or so is the most we think a potential pullback could be on the S&P, and that could be a well-deserved pullback after 12% bounce from the lows here, give or take. But we don't think we'll quite go down those lows, those Christmas Eve lows. We think are fairly significant. Bear market, so we took a look here, a lot of numbers on this page, but the bottom line, the last 4 times at a recession, last 4 times at a bear market without a recession, you can see it's in 2011, 19%, 98, 19%, what else do we have? 87, 34%, and then 78, 19%. A lot of numbers. What's that mean? Well, the last 4 times we had a bear market without a recession, 3 of the last 4 markets bottomed right around 20%. That's right about where we bottom now, right? 87 corrected more. Hey, 87 stocks are up 500% from the 82 lows, 40% for the year in August. Kind of a different scenario in our opinion. So history says without a recession, which we didn't see, stuff we talked about a month ago, we didn't see a recession happening. Maybe stocks bottom right around 20%. Sure enough, that's exactly where they just bottomed now. So if you're in a recession, stocks, bear markets are worse, right? You can have bear markets without a recession. They just tend to bottom around 20%. That's exactly where we just bottomed. Earnings. So did earnings just peak? Probably. You know, we had about 28% year-over-year earnings growth. Let's see, in the third quarter. That's a pretty significant number. I mean, earnings are probably going to come in at 14, 15% the fourth quarter. Like I said, this year, 2019, maybe 7, 8% for the year. So if earnings just peaked, does that mean we're going to go into a recession? No. As this shows here, you have an average of about 49 months after earnings peak of growth before recession. Stocks, as you can see here on the S&P 500 gain on the right, go up nearly 60%. Excuse me. I just love talking about this stuff. I get so choked up. But the median return, almost 30% after stocks peak. And you can still have some good gains. We think that's, maybe possible here. A couple more years of gains, maybe several years of gains, and pretty good equity returns, along with the fact that you have a recession a long way away, even though profits peaked. Because keep in mind, they might have peaked in terms of the growth rate. They're still making new all-time highs in profitability. That's a good thing, coupled with potential positives from the Fed and low inflation. Global earnings, take a look at this. So it wasn't that long. So we've got domestic, meaning S&P 500, developed, and then emerging markets are black. But wasn't that long ago we had a global earnings recession in 14, 15, 16. Stocks didn't really go anywhere for a couple of years here in the U.S. We saw some big pullbacks in emerging markets and in Europe. Good news, 2017, 18, 19, global earnings are expanding. This year we see, as you can see here, developed markets, which actually, as we said, we're not too crazy about, all of a sudden, quietly are expected to gain almost 11%, which is almost 12%, which is pretty impressive. But then you still have emerging markets in the U.S. still growing as well. So overall, let's just keep it really simple. We've never had a recession with expanding global earnings making new all-time highs. You just don't, that's just not a recipe for recessions. Well, if earnings continue to grow and make new all-time highs, just another little bullet point that kind of hopefully calms the nerves that we're going to have a global recession, and why we don't think we will. Oh, yes, we're almost about done there. So that's that. So overall, some key takeaways, I think, for investors. This is an old economic cycle. It doesn't mean it has to end. Various things, as I just noted, say, yes, this is an expanding cycle, but it can still last another year or two, potentially, with earnings continue to improve, with the Fed kind of really going on hold, in our opinion, with interest rate policy getting in line with the economy, oil finally calming down, and then the whole China trade issues. We think some type of resolution is quite likely the next couple of months. It's not going to be easy, right? We just gained about 12% from the lows. John Lynch, my boss, our chief investment strategist, says that's the easy 10%. Off the lows, you get a bounce. The next 10% is going to be tough, and it's going to be rocky. I mean, volatility was a big theme that we had last year, and my goodness, we have volatility. It's still a theme. The economic cycle is aging. It's not going to be straight up like 2017 from the bottom left to the upper right. A couple 10% corrections maybe could be likely. Could we have another 20% correction this year? We don't quite think it might be that much, but hey, you're going to have a lot of volatility, and we'll just have to wait and see. But without a recession, we still think stocks are going to outperform bonds. We're positioning our portfolios to be a little overweighted stocks, a little bit underweighted bonds, but in a well-diversified portfolio, there's always a place for fixed income. When you have those big sell-offs, bonds didn't tend to do well, as we showed on the first couple of slides, where most bonds did pretty well. The higher quality bonds at least did pretty well during that sell-off. So with all of that, I'm really honored to be here this quarter. Hopefully this is informative, and I really look forward to the future opportunities over the coming year and years to talk markets with everybody. So at this point, Tim, I think I'll turn it back to you. Thanks.
Thank you, Ryan, for your thoughts on the current market environment. As a reminder, if you have any questions, please contact us by calling 781-848-9821 or visit us on the web at www.leveroni.com. Once again, you can call us by giving us a call at 781-848-9821 or visiting us at the web at www.leveroni.com. We also would like to hear some feedback from everyone to help us improve the format of these calls. Also, if you know of anybody who would be interested in hearing our market update, you can forward this email to them. Thank you for your continued confidence.